Hey, good morning. Let's go over today's trade plan. So in the overnight session, we saw that the market moved up towards the 93 to 95 resistance zone where responsive sellers were active, and we saw pretty much a complete retracement of the overnight range. At this point, heading into the open, the market environment is fairly similar to yesterday in the sense that on the larger time frames, the markets have already hit some pretty decent upside targets. And as you continue to move higher towards these more aggressive resistance zones, there can be some profit taking that comes into the market, and there is added risk, right? So even though that larger time frame bias continues to be bullish, the higher you go, the less the reward potential on the long side. And at the same time, today is the last day of the month, so there could be some profit taking based on that as well. So it's just something to be aware of that, as you continue to push higher in these markets, you are going to need to see continued upside momentum, and you're going to need to continue to see that upside energy in order to continue to trade at higher prices or even sustain these higher prices. So for that reason, yesterday we started being a little bit more conservative on the long side, and the idea was to be a little bit more nimble with the intraday bias, which means be willing to short as well as go long. Whereas, prior to that, the 4 or 5 days before that, the focus was purely on the long side, and we were taking very aggressive long setups, pretty much buying every pullback into support and even buying, at fairly aggressive prices. But now that the market has hit some pretty decent upside objectives, it doesn't mean that it can't go higher, but as you saw yesterday, it took a lot of consolidation to eventually break higher. So now it does warrant being a little bit more cautious, being a little bit more conservative with the long side. Again, doesn't mean that it can't go higher. It just means we have to be a little bit more careful on the day time frame and make sure that we're not seeing any warning signs or any signals that the market could be reaching a short-term top. It doesn't mean that it's topping out. Again, on the bigger picture, it can still consolidate eventually, go to higher prices. But it's important to be aware of the bigger picture. But as day traders, you also have to be very much in tune with that smaller time frame, because your trade lives or dies on, that 5 minute chart where the variance in price that you can really handle is typically 2 to 3 points. That is the stop size that is used on majority of the trades. So, that's the margin of error. And because of that, there is a certain level of precision that needs to be there. And so all these different factors need to be taken into account. So heading into the open, keep an eye on 82.5 to 84.5. That zone is going to help establish the bias for the day. As long as we're holding above 82.5 to 84.5, we know that even short term, the market is fairly strong. And if we can break out above 87.25 to 88.75, which is just minor, smaller time frame resistance here, then that would confirm that the buy side is in control. And from there, we can go back and retest the overnight high area at 93 to 95. And then if there is sufficient broad market strength and upside momentum, then we can go up to 98 to 2100 and possibly the 03 half naked VPOC, 04 quarter to 06 quarter, which would tag that open gap. But just again, keep in mind that as you continue to push higher, you are going to want to see that sustained upside momentum. And without it, it's going to be difficult to sustain higher prices. It doesn't mean that we can't make a short-term move, but to actually hold up there and continue printing higher prices is going to need sustained upside momentum. Now, we know that the Russell has been relatively weak compared to S&P and Nasdaq, and that's something that on the smaller time frames can weigh the S&P down. So in the Russell, keep an eye on the 1159 to 1161 zone. That's an area that ideally should hold in the Russell if ES is to go higher. And if TF fails to hold 59 to 61, that would be a warning sign. And that could lead to a downside move in the S&P. So on the upside, we know we have these resistance zones that can be used as targets, and the upper resistance zones potentially can even be used as short-term trades on the short side, as long as there are some signs in real time as well, and you're getting decent trade location. But on the downside, if 82.5 to 84.5 doesn't hold, then it would open the door for a move down into the 77 to 79, yesterday's low of 75.5, and the 71.5 to 73.5 support zone. So if we fail to hold initial support, then we could be looking at a move heading down into 71.5 to 73.5, at which point the buy side can start stepping in again. So even though we have support at 77 to 79, in order to trade that zone on the long side, we really have to look at the real-time environment and figure out whether it supports the idea of a complete reversal back up towards the pre-market resistance and 93, 95. So that means that, as we're testing 77, 79, if we head down there, we should not be seeing excessive weakness. It's okay to see some level of weakness, that would be all right, but we should not be seeing excessive weakness and strong downside momentum, because that would lower the probability of the market actually turning around and trading back above the 84, 85 area on the day time frame, which means there won't be enough reward to risk to really warrant a trade. We can still get a reaction there, but to take a trade, it doesn't mean that we're only looking for a small reaction. There needs to be a big enough move to trigger a trade and meet the risk-reward criteria or the risk-reward filter. And until that happens, it's not a trade setup. So below that, we have 75.5, yesterday's low, and then 71.5 to 73.5 is a good spot on the larger time frames, and that's an area where responsive buyers are more likely to be active, and the market would be quite exhausted heading into it. And again, that bigger picture bias is going to remain bullish even if we get a deep pullback. So if you're getting good location and then you have that bigger picture bias behind your back, a lot of times that's enough to trigger a trade. And the zones below the 71.5 are going to continue to be in play as well. So we can still consider taking longs at those zones, but ideally 71.5 to 73.5 caps the downside and marks a short-term extreme on the downside. But even if it went down to the next zone, it wouldn't really change the overall picture of the market, which would continue to be bullish. So the main idea is, we are still bullish on the market. The overall bias continues to support the upside. It's just that the higher you go, the riskier the setups get on the long side, because now in terms of price, you're entering at a fairly aggressive price, and there needs to be continuation and continued upside momentum in order for the targets to get hit. So now we need to be very much in tune with what the market's doing in real time, and we have to give that a bit more weight than we did earlier in the week, where even if things looked weak earlier in the week, we still took the trade on the long side as long as we were getting good location. Now we just have to be a little bit more cautious, a little bit more careful with those types of trades, unless there is clearly strong upside momentum. Then location is not as relevant. When you're taking a momentum trade, location doesn't really matter. You're really relying on that underlying momentum to carry the market higher. So those are the main ideas heading into the open. Again, on the Russell, keep an eye on 1159 to 1161. The bias is still bullish. The buyers can maintain even short-term control above 82.5 to 84.5. How the market reacts at 87 quarter to 88.75 can provide a minor tell on whether we're going to get some decent continuation or not. And we're just going to be open to trading either side. Still a little bit more focused on longs, given the larger time frame bias, and we still do want to see some clear signs in real time in order to trigger a short. But overall, the environment continues to be bullish. It's just that we're a bit extended now, and then running into the last day of the month, we just want to actually be just a little bit more cautious on a day like today. Just Friday afternoons typically can be a little bit more dead. On the econ calendar, consumer sentiment is really the primary release at this point at 9 a.m. Central Time. We have Chicago PMI out at 8:45, and then consumer sentiment at 9. So just keep those in mind too. So those are our main thoughts heading into the open. Let's see if the buy side can continue to maintain short-term control. That'll set the tone for the day, and we'll take it from there.